Y'all, I have been thinking for the last couple years that it was the dryer that was shrinking my clothes, and I just recently discovered it was the refrigerator. So, lesson learned. Hope that's useful information to you. All right, investing away, index funds. Last video was about mutual funds, and index funds are very similar to mutual funds. It's the same concept. So if you looked up a mutual fund and an index fund and stuck them next to each other, they could very likely be identical. The reason why is an index fund is just like a mutual fund in that it is an investment of a bunch of individual stocks. The biggest difference between an index fund and a mutual fund is most mutual funds are going to be actively managed, which means that there's a group of people that, based on what the goal of the mutual fund is, are going to be buying and selling stocks within the mutual fund. And that's where your expense ratios come in. So a mutual fund might have a front load fee of 5.75%. So for every $100 you put in, you're going to pay the managers of the fund $5.75. And then on top of that, they're going to have an expense ratio, which is basically a continual management fee. So every year, if the management fee is 50 basis points or 0.50%, half of a percent, every year the dollar value of your investments in the mutual fund is going to have an expense taken out of it for the managers. Index funds, because they're what's called passively managed, because they're based on an index, usually aren't going to have near as high expense ratios and fees. Most of them are not going to have load fees up front. So you put $100 in, you have $100 worth of the index fund. And then your expense ratios, the ongoing yearly cost, if you will, of owning that fund is very small. It might be 5 basis points, 10 basis points, or 0.1%, 0.05%, whatever it is, and however you want to describe it. It's very, very small. So a mutual fund is going to be actively managed, and the managers are going to buy and sell based on what they think the best end result is going to be for that fund's particular goal. An index fund is based on indexes. So the easiest one to use is the S&P 500, Standard & Poor's S&P 500 index, which is basically an index of the 500 largest companies on the stock exchange. And again, these are companies that we all recognize: Google, Apple, Microsoft, Tesla, Johnson & Johnson, Pfizer, Home Depot, Coca-Cola. They're all up there in that index. And as the company's value change, the companies on the index will change. So you're not going to see much move in way of the top 100 companies, but there are companies that 5 years ago were on the S&P 500 and now they're not there. At one point, Kmart was likely on there. It's not on there anymore. Well, maybe it is. I don't remember seeing it on there, but as the values of these companies change, by nature the index changes, because it's the 500 largest companies by value. So as the value changes, oh no. Oh my gosh, I'm so sorry you guys had to witness that. Oh, I hope I can make that the thumbnail. Wouldn't that be great? So all an index fund does is tracks an index. And that's why it's passively managed. Is it's basically a mathematical calculation, or just a one-for-one replica of the index in a fund. So if Tesla and Amazon and Google, these companies just keep bouncing around on who's the largest company value-wise on the index. As they bounce around, the index is going to bounce around. So if you look at an index 1 month, and at that point Google, which is listed as the alphabet company, and there's different share classes, let's say they're in the number one spot in the index, and they hold 5% of the total value of that index. When you look at an S&P 500 index fund, like the Fidelity 500 fund, the Google shares holding is going to match that percentage in the index. So it's going to be around 5-6%. Because the index passively matches whatever, the index fund passively matches whatever that index is doing. There's other indexes out there. There's the Russel 1000, 2000, 3000. The Russell 2000 is kind of like the top 2,000 companies in the small cap category. So these are companies that are under a $2 billion value, and the top 2,000 of them that fall under that value. And off the top of my head, I really don't know what kind of company would be there. Trying to think of a small company, maybe like I don't even know, guys. I'd have to look at it to give you some more detailed information. But the Russell's an index of small cap. So if you found an index fund that says it's a Russell 2000 index fund, it's going to be invested in those, Russell 2000 companies that show up on the Russell 2000 index. The Dow Jones Industrial Average, or the Dow 30, that's the 30 largest companies, kind of in the what you call like blue chip sector. So Tesla, Microsoft, kind of tech companies, IT companies, those kinds of things. You can get what else is there? The Nasdaq, same thing. I think it's what is it, the top 100 companies or something like that. And then you can get composite indexes. But basically, an index fund tracks an index. So if it's an S&P 500 index fund, it's going to track the S&P 500 index, which just has a predetermined rule of what companies are going to be listed in there. It's the reason why index funds have such low costs, because there's nobody sitting there trying to guess who they think is going to be a winner and who's going to be a loser. All it does is track the index. Index funds are really good for kind of passive investors. You just want to set it and forget it kind of deal. The S&P 500 index last year averaged about 26% annual rate of return. So if you had $1,000 invested in an S&P index fund, you would have earned $260 on it last year. If you had $100,000, you would have earned $26,000. And indexes have good years and indexes have bad years. So that's what an index fund is. It's very similar to a mutual fund. It's just most of the time passively managed, based entirely on what the index is. And you get all different kinds of indexes. Hope that helps. Tomorrow we'll probably talk about ETFs. They're kind of similar to mutual funds and index funds, or at least related to them. And then probably shortly after that, I'm going to do a video of how to find this stuff. When you've created your account at Fidelity or Vanguard and you've got your money in there and transferred and you're ready to buy stuff, I'm going to kind of explain how you find these companies. It's basically based off of their ticker symbol, and we will talk about that at some point later this week. Like, comment, subscribe, give me more dad jokes, give me more bad jokes, and we're all going to have a laugh. Thanks, y'all. See you later.